All right, settle down, you lot. It's your boy Chris, the CMT wizard, and I'm here with the only man who owns more spreadsheets than sense, Morgan.
All right, Chris. And you're the guy who thinks drawing lines on a chart is a personality trait.
Hey.
Good to be here. Today, we're talking about the bread and butter, the absolute foundation of any chart that isn't a complete dog's dinner.
Right.
Important. Support and resistance.
Mate, it's more than bread and butter. It's the whole damn bakery. But everyone and their nan thinks they can just slap a few horizontal lines on a Bitcoin chart and call themselves a trader.
Yeah.
It's not that simple, is it, Morgs?
Not even close. Let's break it down for the new mandem, CMT level 1 style.
Okay.
With less of the boring textbook rubbish. So, support. What is it, Chris? Don't just give me the Investopedia definition, you melt.
Cheeky. Simple. Support is a price floor. Imagine a bunch of buyers are all camped out at a certain level, yeah?
Okay.
Let's say £30,000 for Bitcoin. They've got their buy orders stacked, they've got their alerts set. The price comes down, smacks into that 30k level, and boom. The buyer wall absorbs all the selling pressure. It's like a bouncer at a club.
Yeah.
Not today, son. The price bounces off it. That's your support.
And resistance is the opposite. It's the ceiling, the bouncer on the VIP floor, a level where all the sellers are waiting, thinking,
Right.
all right, if BTC gets back to 40k, I'm out. I'm taking my profits. The price rallies up, hits that 40k ceiling, and gets slapped back down. Supply overwhelms demand. Simple as that.
Exactly. But here's the first mistake everyone makes. They see one little peak, one little trough, and they draw a line as thin as their patience.
Yeah.
Bruv, support and resistance aren't laser lines, they're zones. Think of it like a fat, blurry crayon line, not a razor-sharp pencil. A price might dip a little below support or poke a little above resistance before it reverses.
Right.
It's a zone of interest, not an exact number.
That's the first gem right there, and it leads to the why. Why do these levels even exist? It's not magic. It's because thousands of traders are all looking at the same historical data.
Yeah.
That peak from 3 months ago where the price tanked, people remember that.
Yeah.
They think, that's where the big boys sold last time. Maybe I should sell there too.
Right.
It becomes a self-fulfilling prophecy.
It's collective memory. Like when your ex texts you at 2 a.m. You remember that's a bad zone, yeah?
Yeah.
You resist. The market is the same. It remembers past pain and past pleasure. A level where everyone got rich buying a dip becomes a future support level because they're all waiting to do it again.
Let's get practical. Drawing these things. How do you do it, Chris?
Mate.
Because I've seen some charts that look like a togger's been at them with a pack of Crayolas.
Don't get me started. Rule number 1, zoom out. Stop looking at the 5-minute chart, you degenerate. Go to the daily, the weekly.
Yeah.
The higher the time frame,
100%.
the more significant the level. A support level that's held for a year is a brick wall.
Right.
A support level on the 1-minute chart is a paper-thin napkin.
100%. And you want to connect the most obvious swing highs and swing lows.
Exactly.
The points where the price made a major U-turn.
Yep.
You're looking for multiple touches. If a level has been tested 3, 4, 5 times and held,
Wow.
that's a 5-star Michelin grade level. The more touches, the stronger the level.
Preach.
It's about finding the obvious levels.
Right.
If you have to squint and tilt your head to see it, it probably ain't real. It should jump off the chart at you. Okay, so we've got our zones drawn on a high time frame. What's next? This is where the real source is. The support resistance flip, my personal favorite. Chris, you say it up.
The flip. The most beautiful play in the book. It's simple. What happens when a support level finally breaks? All those people who bought at that level thinking would bounce, yeah?
Yeah.
They're in a losing position. They're underwater. They're sweating.
They're bag holding.
They're bag holding hard. All they're praying for is for the price to get back to the level they bought at so they can sell and get out for break even.
Right.
So the price grinds back up to that old support level, and what happens?
Bam! All those bag holders dump their coins. Get me out. Their selling pressure, combined with new sellers who see the old support as a new ceiling, turns that level into resistance.
Boom.
The floor becomes the ceiling. That's the flip.
And it works the other way, too. When a resistance level breaks, everyone who shorted it is now getting squeezed.
Right.
They're desperate to buy back their short to limit their losses.
Right.
When the price dips back down to test that old resistance level, they buy, new buyers jump in, and the old ceiling becomes a new floor. Old resistance becomes new support.
This is where you find your A-plus trade setups. You see a strong resistance level get smashed on high volume. You don't FOMO in at the top.
No.
You wait. You wait for the price to pull back and retest that level from above. You see it hold as new support, maybe a bullish candle pattern forms.
That's it.
And that's your entry. Low risk, high reward.
Clean as a whistle. But let's talk about the pain, the part that separates the pros from the plebs.
Okay.
How many times have you seen it, Morks? Price screams through a resistance level, you ape in thinking it's going to the moon,
And then 5 minutes later, it slams back down, stops you out, and leaves you looking like a proper wally. That's a fake out, or a liquidity grab, as the cool kids call it.
it's pure psychological warfare. So how do you avoid getting rinsed by fake outs?
How?
The secret ingredient, ladies and gents, is volume.
Tell them, Chris.
A rail breakout happens on massive volume. Think about trying to smash through a brick wall. You can't just tap it, you need a sledgehammer.
Right.
That sledgehammer is volume. If you see the price creeping above resistance on pathetic low volume, be suspicious. That's a trap. It's a weak move. But if you see a huge green candle smash through the level with volume spike that's double or triple the average, that's confirmation. That's conviction. And even then, I'm still cautious. I wait for the candle to close above the level.
That's key.
Not just wick above it. A wick is a rejection. A full body candle close is a statement. For extra safety, I wait for the retest. I let the market prove to me that the old resistance is now support. Patience pays. FOMO kills.
All right, let's get a bit more advanced. Not everything is a nice flat horizontal line.
Right.
Let's talk about dynamic support and resistance.
You mean trend lines and moving averages? This is your CMT territory. Go on then. Trend lines are simple enough. In an uptrend, you connect the higher lows. In a downtrend, you connect the lower highs.
Yep.
That line then acts as a dynamic moving level of support or resistance. The price will often come back to kiss the trend line before continuing on its way.
The key here, again, is multiple touches. A trend line with 2 points is just a line.
Just a line.
A trend line with 3 or more confirmed touches is a trend you can respect. And don't force it. If the line doesn't fit neatly, it's not a valid trend line. Then you've got moving averages, the 20, the 50, the 200. These can act as incredible dynamic S&R. In a strong bull market, how many times do we see Bitcoin pull back to the 21-week EMA and bounce perfectly? Countless times. It's because, again, everyone's watching them. The big funds, the algorithms, they're programmed to buy at these levels. The 200-day moving average is the big one. Institutions see that as the line in the sand between a bull and a bear market. A break below that on the S&P 500 and you know things are getting serious.
So you can combine these, right?
Yeah.
You might find a spot on the chart where a horizontal support zone, an ascending trend line, and the 50-day moving average all converge at the same price.
Yes.
That's what we call a confluence area.
And when you get a bullish pin bar candle right at a major confluence zone, mate, that's the trading equivalent of the heavens opening and a choir of angels singing, yes!
Yes.
That's a signal you can bet the farm on.
Metaphorically, of course. Don't be a degen, manage the risk. All right, let's wrap it up with a real-world example. Think about Bitcoin's run to 69K in 2021.
Okay.
What happened before that?